Hi, everyone. I'm Maggie Lake here with Francis Gannon, the co-chief investment officer at Royce Investment Partners. And we're going to take a look at investing in the small cap area of the equity market and ask the question whether this might be a time to look for value in these bearish times. And probably, Francis, how to navigate these bearish times because it's been pretty tough sledding. How are you?
I'm well, thanks. Thanks for having me, Maggie. I appreciate it.
Yeah, it's great to catch up with you again. And it has been a really challenging year, no exception for small caps. I mean, they've taken it on the chin like so many other parts of the equity market. How are you thinking about this economic environment right now? What's your base case for growth and inflation?
Yeah, you're right. It's been a very difficult year, at least start to the year. Who knows what the rest of the year is going to prove out to show. But from our perspective, in the small cap space, we're down about 32% peak to trough from the high of last November through the lows of June here. So it has been a pretty painful time. And in that decline, we have actually seen the average stock in the Russell 2000 decline about 48%. So there's been a pretty significant drop across small caps when you look at it by a stock basis. From an economic perspective, here we are, the S&P is now in a bear market, small caps are in a bear market. The economy, from all we hear, and this is all very bottoms up driven because we're not top down in terms of our approach, but from a bottoms up standpoint, from what we're hearing from companies, at least through the end of the first quarter and into the second quarter here, is that demand remains quite strong, that the economy is slowing. But we might not be in a recession as of yet. Now, the classic definition of a recession, as you know, is 2 back-to-back quarters of negative GDP growth. You've seen a negative GDP quarter in the first quarter of this year. You're seeing the Atlanta Fed models right now predict kind of a 0%. So the possibilities of us having that negative GDP print for the second quarter is becoming increasingly more real. It seems the market is grappling with recession on a daily basis. And you've seen, a big move in yields. But at the same token, from what we're hearing, at least from these small businesses domestically in the United States, demand for the moment remains strong. So while we might enter a recession at some point in the latter half of this year into 2023, I don't know. But from what we're hearing from a lot of businesses, things seems to be okay for the moment.
Well, and I think that's why it's such a great time to catch up with you because your focus is on small caps. You are talking to, managers and companies and the executives of these this is this engine of growth in many ways, these small to mid-sized companies. So it's a really good sort of forward gauge, I think, on the economy and what they're thinking about. And layer on that, the fact that you guys have been around and operating since I think the early 70s, if I'm not mistaken. So you've seen these business cycles, you've been through inflation, you've been through higher interest rate environments. And I think that sort of experience perspective is so important right now. So when you're out talking to managements of small companies, what's top of mind for them? I mean, what are they most concerned about?
I mean, the common word we hear, and I think it's true kind of anywhere you go today, is inflation, right? The inflationary pressures that they are feeling. Many small businesses are able to pass that along from a pricing perspective. And I think that's been quite interesting that they haven't had any pushback from their clients yet about pricing. So pricing has been able to be passed along. And I think when you think about, to your comment about we have been doing this for a long period of time, when you look at inflation, small caps are the only asset class that have beaten inflation in every decade going back to the 1930s. So here you have an asset class that typically does quite well in inflationary times. It's obviously under pressure at the moment with the rest of the market, but it's going to be interesting to see how the rest of the decade turns out. And I do think that the pricing power that a lot of these small businesses have, and a lot of that is around this idea of them being more B2B in focus, right? So they're more built-in products into other products that are necessary pieces of the puzzle, if you will, that gives them that flexibility. And I think you're going to hear more and more about that from a lot of small businesses going forward.
That's so interesting because I've often been wondering about this when it comes to small caps, about whether they are more resilient in an inflationary environment. So is that the only thing, is that where the sort of secret strength is, the fact that they're more B2B? Does that mean they're not sort of exposed to the consumer and that knock-on effect of higher prices and the Fed trying to kill demand? Are they just not as exposed to the demand side of the economy in that way?
Well, they are exposed. I mean, most businesses are eventually exposed to the demand side of the economy, right? And small caps are not, able to just completely miss that. So they do have those pressures. And then it depends on what sector you might be looking at as well, right? Obviously the consumer aspect of small caps obviously has that pressure. What we're trying to focus on here within our world is these better, higher quality small cap businesses that have really been able to use the COVID period to become even better companies, and now have the ability through either technology, automation, et cetera, be able to deal with some of these inflationary pressures in ways that I think people might find unexpected. And so that's all part of what I think the conversation is with these businesses today. And really from our perspective as small cap managers is why small caps now, right? Why do you want to invest in these particular businesses today? And the general thing we hear from these businesses is, one, demand is pretty strong. Two is we're able to pass along pricing. And three is many of the aspects of our business that we were able to improve during the COVID shutdowns, if you will, we were able to pull forward and do a lot of these things, be it refurbishing plants, whatever they might have been able to accomplish from a technology standpoint, is really going to pay off for them from an earnings perspective. So I think that's all pieces of the puzzle when you look at the small cap asset class. We can never outrun demand, right? Demand is always going to be a part of it. So, but at the same token, there are these great businesses out there that we can focus on.
That's so interesting. What about interest rates? So the two issues that the market in this new regime that everyone's grappling with is inflation and then rising interest rates, right? If you got higher borrowing costs and you're seeing the tech area just get killed on this, anybody that's relying on future earnings or anyone that has a high cost of capital, what does this new regime mean for them if we are in a different period? How does that lay on top of the small cap space? I mean, are there balance sheets in general strong enough to handle higher borrowing costs? I would have thought they'd be more vulnerable.
So two things there. One is, the tech companies that are getting hit today, higher rates are causing people to kind of refocus and pivot away from those long duration assets, which have done so well for a period of time. And that's key to what I think is happening in the market and the shifts we're seeing in the market with those big tech names underperforming and have been underperforming now for a period of time. And I think those areas of the market are going to be, as we've been saying internally here, the ATM, if you will, the cash machine for the rest of the market. We have been investing in the same companies in a zero interest rate policy world or very low interest rate policy world for a long period of time. And so for us to talk about investing in small cap companies that have cash flow and earnings, is kind of an odd thing when you could just buy Apple or Google or whatever you wanted to buy for the past 10 years. Now I think the market is shifting. So I think as rates move up, the focus of the market is changing. So that's kind of the first part of the answer, I think, to your question. The second part of the answer goes to the fact that one of the myths around small caps and small caps investing in general is that they are over-levered businesses. That and what we find in our history of doing this for a long period of time is that many businesses do not necessarily need access to the capital markets. And so one of the things we like to take off the table from a risk perspective within small caps is those over-levered balance sheets. So we tend to focus on businesses in many of our products here that don't need that kind of financial leverage, right? We're bigger fans of operating leverage within the underlying business, but these are companies that have cash flow, that actually pay dividends at times, can give money back to shareholders in a variety of different ways. And so they don't have that added stress of what might be going in the overall market from a rate perspective, and rates going up, because they don't necessarily need that access to the capital markets.
Yeah, you're right, because I do think there is a perception that they're kind of running lean and really needing, to constantly roll over and tap into borrowing. So that is I think a misperception out there. So Francis, when we're talking about small caps, we generally look at the Russell 2000, but that tells you that there's an enormous amount of companies that fall under that umbrella. What do we need to, if you sense there's going to be a big rotation out of just the passive dumping into large tech, and maybe now a shift into other areas in the market, and maybe back into small caps, what do investors need to understand about looking at that market? I mean, I'm sure we can't paint the entire market with one, stroke. There's a lot of differences under the hood. How do you go about separating it out and thinking about it?
Sure. I mean, let's start with the idea that I think, and this is kind of an odd thing to say, but I think small caps have been the forgotten asset class of the markets over the past decade, maybe even going back to the financial crisis or right after the financial crisis. And I think a lot of that has to do with the fact that, indexing, ETFs, the growth of those passive world, and everybody just buying the same type of businesses. So in a market cap weighted world where those upper end of the S&P 500 or the Russell 1000 really driven by those huge companies, trillion-dollar companies, they continue to grow. And it just kind of was a self-fulfilling prophecy, if you will. Just things just kept moving in that direction. As that continues to unwind, what we're finding is the market is going to gravitate back to real businesses. Not that those technology companies were not real, but that the earnings power of our companies is going to be a little bit stronger. And so we work in an index, as you said, the Russell 2000 is a very big, large index. It's an index where about 43, maybe 44% of the index at the end of the first quarter was comprised of companies that had no earnings at all. So we tend to focus on real businesses, if you will, businesses that have cash flow and earnings, and the ability to give back to shareholders. And so I think that's kind of how we start looking at this huge inefficient asset class, is really understanding these businesses. Then we just roll up our sleeves and we do a lot of research. I think I work at one of the largest ongoing small cap investment conferences, as we meet with somewhere between 7 or 8 companies a day around here, either in person when we can, or virtually. But you get to know the businesses, you get to understand them, you get to have this deep domain knowledge about this asset class, and we're able to share that and build portfolios in a variety of different ways because we have that domain knowledge.
Yeah, which is, by the way, that used to be how it was done, right? Like really understanding the business and where it's going, the quality of management. I mean, this was how things, how it used to work. And I think, a huge sort of, there's a lot of value in that. I mean, that should be a really important part of your investment decision making process. And somehow it feels like we got a little bit removed from that. So it sounds like you think active management is really what's needed in this space.
Yeah, and you can take that even further, Maggie, with the idea that many of the large research firms don't even do research on small cap companies anymore. And so you have a lot of our businesses don't have the street coverage, if you will, that say, the large cap names have. So we're doing a lot of our research on our own. And we have a very large research staff that really helps us do that. I do believe active management is going to be the key here. I do think part of what you're seeing in this, pivot, which is a byproduct of the Fed pivot that started last year, is that active management is going to be increasingly more important, especially in the small cap asset class, where it is so inefficient. And I think that's part of the opportunity set we're seeing today in small caps is we have to be using this volatility in the overall market where you're seeing stocks off 48, 50% from their 52-week high to really buy our future returns. And if you can look out a year or 3 years from today, I think, that you will make have nice returns on those investments over time. And that's kind of what our goal is right now. I know that if we miss those first couple of trading days off a low, wherever that might be, that our performance is going to suffer. So we're using this moment in time to take that vast domain knowledge in this asset class from a research perspective and add to or buy the businesses we think will be the best businesses to own going forward in this particular time. And a lot of that can be the same businesses we own today, right? That we're just high grading the overall portfolios.
In the broader market, there's a big discussion between rotating out of growth into value, or whether that's, overshot. And if there is eventually going to be a bottom found, there's the tension between that. In the small cap, is that also a fair way to think about breaking things down, growth versus value? Are they more connected in small cap, or do you have to think about that area of the market in the same way?
There's a couple of themes. I think a couple of themes that we've been thinking about within the small cap space. Obviously, value versus growth, right? Value has done a little bit better here in the decline. I think from their highs, they're only down about 22%. The Russell 2000 is down around 32%, and the growth index at the most recent low is down around 42%. So you are seeing some outperformance by value over growth. I continue to believe that value is going to be one of the areas to be invested in going forward. We know that even with the movement in the markets, the value index is still much cheaper than the overall growth index. And I think that's something that we can be, pretty excited about, even in an environment where value has outperformed at least so far in the down market. So obviously, I think small cap value is an interesting place to be today. The other theme I think within small caps is high quality versus low quality, and high quality companies within the small cap space is another area that we think are very cheap. Going back over the past 20 years, we haven't seen these companies as cheap as we're seeing them today. And I think that's another area which also feeds a little bit into that value story, if you will. These better businesses is an area to invest in today. And then, the last piece of the puzzle that we get the question on an awful lot is small versus large. And I think small caps, as I, mentioned or alluded to, I think they're kind of this forgotten asset class. They are selling at about a 20% discount to large caps. And it's typically a premium. We typically see small caps trade at a premium, and now we're seeing them sell at a significant discount. And it goes back to this idea that people really haven't focused on them for a period of time. They've underperformed for a period of time versus large. But I think you're in the beginning stages of what should be a small cap outperformance period. Part of that goes back to one of our most recent studies has been on volatility and looking at the VIX. And what we found was in markets like this, when you're seeing the volatility index greater than 25, and obviously we've been in the low 30s of late, we see strong performance from small caps on both a absolute and a relative basis following these very highly volatile markets. Typically, the subsequent 3-year annualized returns are pretty strong. In fact, for the Russell 2000, it's about 14.1% versus about 9.4% for the Russell 1000. So you see large caps outperform 83% of the times in those 3-year periods when you're seeing the VIX as high it is today. So I think that, coupled with the fact that small caps have underperformed for a period of time, I think the moment is ripe, if you will, for people to start looking at the small cap asset class.
It's interesting you mentioned VIX, because I think we have definitely seen people very concerned about liquidity and wanting to stay in the safest, most liquid assets, means cash, spend the dollar, to some extent gold, but not really. I mean, people have really been favoring cash. I think because of this extraordinary time room, we have massive geopolitical tensions. We've got the Fed rolling off their balance sheet. In this risky time, are there any liquidity concerns in small caps that might be holding people back who might otherwise be interested? Is there something we need to understand about that?
At the moment, we have not seen any liquidity risks in the market. In fact, everything, while it hasn't felt orderly in terms of the decline has been very orderly from a liquidity standpoint. So we have not noticed any issues around liquidity, at least as of yet.
Mm. So when we're looking at sectors within, if you think value really has sort of an upper hand or the potential to outperform, are there sectors within that area of the market that you like, that you think could get some headwinds against the economic backdrop we've been talking about?
If you do look at value is like quality, right? It's an overused word within our investment space. Everybody thinks what they own is of value. In our world, the value today, I think, is being found and created on a daily basis, especially in these volatile markets. But we're finding it in industrial businesses, economically sensitive businesses. We're finding it in We're finding it in consumer-related businesses that obviously are getting hit quite hard, feeling the pressure of inflation. We're seeing it in technology businesses, and I would say not the sexy part of technology, but the boring part of technology. Not the areas that have done well because software, internet-related businesses, but really boring kind of widget-type technology that is becoming increasingly more attractive. We're seeing it in financials. We're seeing a really interesting pricing cycle within insurance companies within the financials today. So there's all these different pockets of value being created in the market today that we're trying to take advantage of. There are certain markets or parts of the market we tend to probably not invest in just stylistically, be it Reits or utilities. So we tend not to kind of focus on those specific areas. Energy has been an area that has done obviously quite well this year, given what's happened in the underlying price of natural gas and oil. We have some investments there, but it's typically more the suppliers to energy companies, not necessarily the E&P companies, those companies involved in the day-to-day drilling. It's been kind of our way of playing it. And I think even in a market where we think quality is so cheap, value's been part of the energy's been part of the reason why the lower quality companies have done so well this year. I think that's part of the shift that you're going to be seeing. We've been living with inflation now for a period of time. And we're kind of getting used to it. I think companies are getting used to it. And I think one of the more interesting aspects about today's market is the speed at which things have changed. Right? A year ago, a year and a half ago, we were still talking about the reopening trade. Think about last summer, and we were still talking about those companies benefiting from a reopening of the overall economy. Now we're scared to death of a recession. A year ago, we were talking about transitory inflation. Now we're talking about permanent inflation. And it's how quickly things have changed. You look at the bond market, look at the equity markets, how quickly they've declined this year. And the bond market has, doubled effectively in terms of its yield, if not more. So I think one of the speed of change has been impressive. And yet here we are still surviving, if you will. And I think that's creating opportunities to own really good businesses within the small caps sectors, really across many sectors.
I mean, we've talked a lot about diversification in portfolios, and this is one way to do that. You brought a really interesting point about, some of the energy companies, the supplier to energy. Do small caps present an opportunity if you are bullish about an area and looking to build a portfolio around that trend, say people who think inflation is here to stay and are keen on energy, to look into the small cap to kind of halo off that larger macroeconomic trend? Is that something people should think about doing?
So I think you can do that in a lot of different areas within small cap, not just necessarily energy, but energy is one of the areas. Obviously, you're seeing incredible move in terms of the underlying commodities this year. And that should translate into better earnings for those companies that supply housing, that supply underlying products in the exploration of those commodities. And so that's a unique way, I think, to play them without having the exposure necessarily directly to the commodity. This is a way that you can play it. The same can be true in other areas of the market as well, within industrials, looking at materials, looking at steel, et cetera. Some of those areas of the market, you find a lot of the same type of trends. So I think, small caps offer us that opportunity.
Are there areas, you mentioned that you don't do really focus on REITs or utilities. Is it just because those are just not the sort of areas of expertise that you've chosen to focus on? Or there are areas within or sectors within small cap that you feel are risky that you would avoid?
So the REITs and utilities goes back to the fact that just the type of businesses that they are, that they're not necessarily the type of businesses we would invest in given our investment philosophies. And they're, more regulated on some issues, and they have to actually pay out most of their earnings. And I think that's always been something that we have shied away from. One of the areas of the market that we had been shying away from, just because it's very difficult to find companies with earnings, has been healthcare. But we have been able to start with the decline in general, find some really interesting businesses within the healthcare space of late. One of the areas that I think we're struggling with, or not struggling with, but I would say, would focus away from, if you will, would be those non-earning sectors of the overall market. And I think that's relatively broad. But I think in an environment where the market is going to really focus on the E of the PE, you really need to have earnings today. And so that whole non-earnings area of the market, which can be found in all sectors of the Russell 2000, is a great place to avoid in this type of market where rates are going higher, where you can no longer kind of value a business at a zero interest rate policy space and 20 years down the road from a long duration asset. So the earnings component is going to become increasingly more important and should be top of mind in many investors' world today.
So, as we look out for the remainder of this year, do you have a sense that does it feel like things are bottoming? Or do you think we're going to be in this there's another leg down in this bear market where you're just going to have to continue to load up on what you think is going to be valuable and wait for that turn? So hard to call the bottom, but, where do you think we are in that?
I'm trying to use history as my guide to answer that question. The Russell 2000 has had 12 bear markets of greater than 20% in its history. And we are currently in one of those particular markets. The average decline is about 32%. The current, peak to trough moment for the Russell 2000 is about 32%. So we're kind of in line with where we have been traditionally. Now, that doesn't mean you still can't have another 10% decline from here as we get closer to, the bottom, wherever that might be. I think people in general are looking for a big crescendo. They're wanting this moment that, everything screams, this is the bottom. I think this is an environment where you're not going to get that. And the bottom might take a couple of months to actually, happen. And so second quarter earnings reporting period are going to be increasingly more important. I would tell you that, when I look at the economy and the slowing economy, the economy is still working. It's still open. There's still pockets of strength. And I think people forget that you have regional, pluses and minuses typically in the United States, just given the size of our overall economy, but it's still open and working. It might not be perfect here today. It might not be growing, 2% plus. It might be 1%. It might be zero, wherever it might be, but it's still open. And I think that's something to remind ourselves. When we had the COVID correction in the market, when the economy, the global economy effectively shut down, small caps were down around 41.8%, and the economy was shut down. Today, we're down about 32%, and the economy is slowing, but is still open. So I think as we look for that bottom, the elusive bottom, wherever it might be, I keep feeling we're not going to get that huge crescendo. Could be wrong about that. That will just say this is the moment. And our job is to really dollar cost average into the weakness when we're seeing it. If you're seeing the market down 32% or the average stock down 48% from its 52-week highs, that means you're seeing other stocks down 50, 60, even more percent down from their market high. So I think that gives us the ability to buy really good prices, not knowing we're going to get that perfect bottom moment. But a year, 2 years, 3 years from now, 3 to 5 years from now, I think the opportunity set enduring that job today is going to be quite important for our shareholders.
Fantastic perspective, Francis. Thank you for bringing all the insight and those years of experience. We appreciate it.
You're so welcome. Thanks, Maggie, for having me again. I really appreciate it.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.